All right, good morning, guys. I want to continue finishing up the cash flow statement. One thing to note is I've realized I want to double check this morning, but tomorrow is the earnings call for the Amazon fourth quarter annual, kind of year-end information, report, which is going to be helpful for us in understanding some projections, especially things in the cash flow statement that we're going to discuss today. So I'm really kind of waiting for that report to come out. So next Monday will be a little bit more fruitful. Today, what we want to do is I'm going to open up the model here, is continue, whoops, that's my solution key, is continue with the cash flow statement. And as you might recall, I've talked about it a couple times. We talked about the derivative of the cash flow statement, namely the cash from operations, and how it really is summarizing which operating items from the income statement is non-cash. And so cash from operations is, in summary, your net income, adding back those non-cash items: depreciation, deferred taxes, and working capital. And then there are other movements in cash or investments and paydowns in cash, specifically cash from investing activities, which includes the purchases of equipment, the purchases of property, the sale of property, the sale of businesses, the purchases of businesses, and buying and selling investment securities. Then there's financing activities, and financing activities is the raising debt, paying down debt, raising equity, buying back equity, paying out dividends. Those are the general. We talked about this for the past couple classes now. So we dug in, we laid out the cash flow statement, and in putting together historicals, noted that for the most part, we are laying things down line by line, kind of verbatim, as per what the financials had dictated. And the reason why I'm highlighting that is because, in contrast, in the income statement, we kind of had to move things around, right? The income statement is a little bit more subjective. It's subjective from an accounting perspective in terms of what you would, how you would record revenue or how you would record costs and expenses. And it's also subjective in the formatting, especially from an analyst perspective, because we focus on EBIT and EBITDA for analysis. EBIT and EBITDA is not a GAAP requirement. So we have to move things around to make sure EBIT and EBITDA come to light. So the income statement, we really want to kind of move, reorganize a little bit. The cash flow statement, we want to pretty much lay it out line by line. The only thing that we did is a consolidation, I believe. And that's the one thing that you might want to do where, okay, well, there's two things. Let me talk about the second category in a second. But where I believe this was definitely in Amazon's scenario where a borrowing or an issuance of debt is a cash inflow positive, a pay down is an outflow. We like to have that in one line item, where sometimes on the annual report they separate that out. They separate out the issuances from the pay downs. Logically speaking, that's because a lot of people want to see, well, if you see, I want to see the gross, not the net. But for us, the way things link through the rest of the model, it's important for us to see it combined together. So when you look at this line item, line 31, long-term debt borrowings and repayments, you can see the formula in here where we consolidated. And you can look for more information on in last class, but more specifically, it's because we're going to link this in from the debt schedule in such a way that it makes a lot more sense to have it combined. The other thing to note, although we didn't have to in this Amazon example, anybody that's looked at my other books in Walmart, for example, we had to make some changes to the operating working capital section. Why? We'll talk about this more when we talk about operating working capital, maybe not next week, but the week after, is because operating working capital, the operating working capital is current changes in your current assets and current liabilities. That is also not a GAAP requirement. There's a difference between operating working capital and working capital. Working capital could include non-current items and can include some other items that we might not want when considering operating working capital. And it's important from a modeling perspective that we identify this as operating working capital. Not all companies do that. So if you think that operating working capital is current assets and current liabilities, sometimes you might see some non-current items in here. And if you do, you want to take them out, and you don't want to delete them, but you want to put them out of the working capital section. So by doing that, you're not changing the total numbers, you're not changing the company's numbers, but you're narrowing this section down to just the items that reflect the current, because the current is going to be modeled off of our operating items. And this is going to make more sense and be more significant when we look at modeling out the working capital schedule. Okay, so those are the two slight adjustments that we make: operating working capital and some consolidation. Okay, so that being said, we've modeled out the top section of our cash flow statement as best we can. We pulled net income from net income, depreciation from depreciation. This amortization is just part of the template. We modeled out as best we can some of these line items. I'm going to make these, put these in black font. I'm sorry, because these are formulas. And then noted that deferred income taxes will come from our depreciation schedule, and the working capital items will come from our working capital schedule. So that sends us down to cash from investing activities. The main line item in cash from investing activities is Capex. It's the capital expenditures, capital, the purchases of property, plant, and equipment. This is different from other purchases, because why it's identified in Capex is this is usually money set aside for the ongoing improvement or a renovation of property that you already have. And so it's not like, okay, buying new property, which might be kind of one-off, right? Every couple of years you say, oh, well, let me expand my business. That's a different decision-making process. This is more, all right, every year we got to put, $12 billion into, upkeep of our equipment. Taking that one step further, Amazon being an example, it could be, all right, every year we want to invest in 5 new warehouses. And that's probably why this is climbing. So I want to watch that, and I'm going to watch that on tomorrow's earnings call. By the way, I recommend everybody to get on tomorrow's earnings call and give you a great perspective of how the company thinks about themselves. You can go to Amazon Investor Relations and sign in and live. I got to find out what time it's on and listen to it. I'm going to listen to it. So typically the CapEx is modeled on revenue, because revenue is the driver of growth. So I've rarely seen it modeled separately. That's one thing to talk about CapEx. Number two, CapEx is something that's often talked about and planned by the company. So for example, and this is why I'm looking forward to tomorrow's earnings call, even though CapEx is one of the projections, businesses often talk about what their CapEx is going to be next year, which is unusual for projections. A lot of companies don't really explicitly state their projections. CapEx is one thing, capital spending. We expect capital spend to be XYZ. So again, we're in a kind of funny time where I'd be a lot more informed tomorrow, but I want to lay out at least a template. Maybe next week we might tweak these assumptions a little bit, but I want to show you the mechanics of it. So we're going to build this off of revenue. And what I'm going to do is I'm going to add a row under CapEx. So right under CapEx, I'm going to go Shift Spacebar, highlights the column, Control Shift Plus, adds the row, and I'm going to add percent of revenue. Oops, percent of revenue. Okay. Italicize. Okay, and I'm going to get a percentage. I'm going to divide this by the revenue to see historically what the percentage of revenue was. Now, this is a negative number. Revenue is positive. I don't want a negative percent. I want a positive percent. So I'm going to say equals negative CapEx divided by Go to the income statement, revenue up top. Okay, so I'm going to format this, italicize, percentage. I'm going to add a decimal here, and I'm going to put this in black font because this is a formula. And I'm going to copy this to the right 2 times. Highlight the 6.7 while holding down Shift, tap the right arrow twice, Control R. Okay, so interesting, this is bouncing around. Even though the CapEx is growing, the percentage is not growing at all because the revenue is growing. So this is falling in line with why oftentimes we model CapEx as a percentage of revenue, because it's commensurate with the business growth reflected by the revenue. So what I'm going to do for now, although in my research on Amazon, I believe they're going to increase their CapEx this year, given the pandemic, given that their business has really kind of grown further than expected. But we'll learn more tomorrow. I'm going to take the last year's method. Notice the last 2 years are very similar, around 6%. I'm just going to take 6% and go equals to the last year. And let me reformat this percentage, add a decimal. I'm going to make this blue because this is my assumption. And I'm going to back calculate into what the implied CapEx would be on 6% growth. So I'm 6% times revenue, but it's CapEx is cash outflow. We'll say minus 6% times my 2020 revenue. Okay, so minus 22 billion. Again, I have a feeling that this is going to shoot up a little bit more, but we'll tweak this after tomorrow's call. Take everything, copy to the right. These are my CapEx projections for now. Okay. Now, the rest of the investing activities falls into 2 major categories: buying and selling of businesses and other assets, which are typically one-off, and investing and purchasing in securities. Now, conceptually, I think about these from 2 separate perspectives. Now, there is one category, I put it in my book, so I'm going to put it in this book, when thinking about the cash flow from investing and financing activities, as items dependent on cash available. Okay, so in other words, when you, let me see how to simplify this. There are three major categories of items that are dependent on the availability of cash: buying businesses, paying dividends, buying back shares. Where, if typically from an analyst's perspective, when we are modeling out the business, or let's say you were the CFO or in operations at Amazon, the purchasing of businesses, the paying out of dividends, and buying back shares are secondary to cash needed to keep the business, for survival of the business. They're one step removed. In other words, if the business is suffering, right, some things you might do is you can cut out the purchasing of other businesses and the business will continue to survive, right? You can cut out buying back shares. Buying back shares is an initiative if you have a lot of cash. You can, most detrimental, but you can not pay dividends if your business is struggling, although not recommended. But these are things you could do. So in other words, the reason why I'm saying this is where you kind of want to put your investor hat on or your analytical hat on when modeling. When I see line items that are related to business acquisitions, share buybacks, paying down dividends, I say, you know what? Let me wait to see if I have a surplus of cash before modeling that out. Those are items led to cash available. So for example, when I look at this business acquisition line item, and most companies have this, they're buying businesses. Look what they did here. They made a $14 billion acquisition. This is not going to happen every year. They made a $2 billion acquisition in 2018. They made another $2 billion acquisition in 2019. You might say, okay, I'm going to assume this is a one-time anomaly and be conservative and take the average of these two or take the last year, and that would be fine. But what I'm going to say is I'm going to assume in a risk-averse scenario that they're not going to make any acquisitions until I see what the cash flow of the model comes out to be. Now, knowing Amazon, I think they're going to be very cash rich this year, but I want to make this 0 for now, highlight this red, and come back to it and say, well, I want to do some more research and see, are they planning a big acquisition? Another perspective of thinking about this is a precursor to M&A. A pre-strategy to M&A is debt issuances, share buybacks, dividends. If I have money, what am I going to do with it? First thing you might want to do, pay out dividends. You announce a dividend payout, investors are happy, stocks go up. Let's say I still have cash. Buy back shares. You buy back shares, less shares in the market, leftover investors are happy, anti-dilution, shares go up. Let's say I have even more cash. Want to do business expansion, want to have an assertive strategy. Let's go out and do some M&A activity. Let's buy some businesses. I don't want to assume, unless I know what the business strategy is, that I'm going to always buy businesses. Depends on the cash. Let me keep this 0 for now. And I'm going to have the same mindset when thinking about share buybacks and dividends. Now, with Amazon, they're not paying dividends and they're not buying back shares. Okay, so easy here, but I talk more about it. I talk more about it in the Walmart book, and I'm going to talk more about it in this Amazon book when I write it. Now, conversely, this is the company selling businesses. Okay, they are selling, and maybe old warehouses, maybe old equipment, and profiting a little bit off that. $2 billion in old equipment, $4 billion in old equipment. I'm again here going to be super conservative. I'm not going to assume. I can go through the 7 methods of projections and say, well, I could take the minimum, which is they're going to make $2 billion from selling equipment. I call it absolute conservative. I'm going to override the 7 methods and say, you know what? I'm not going to assume they're going to make any money from selling businesses. I'm going to hard code this at 0. I'm going to be very conservative here. I'm going to assume no M&A activity until I know better. And I'm also going to not assume they have equipment readily available to sell. They might not. I want to build a conservative model. Now, a couple of caveats to this, because you might think, well, this sounds so random. How am I going to know all these special extra rules Paul's making? One thing to note, when it comes to valuation, and we'll learn this in the discounted cash flow model, what really matters is your OpEx and your Capex. This is going to be your DCF. A lot of this stuff, anything under here really doesn't matter, really isn't going to go into our valuation anyway. A lot of this is just modeling out intricacies for our debt schedule and just being accurate. So it might give you a little bit of comfort to think, well, this is not really going to impact our valuation per se. If you already studied DCF, and we'll learn when we get to valuing, discounted cash flow is really your cash from operating activities less Capex. This is their cash flow, $25 billion. Okay. Now, investments, proceeds, and marketable, non-marketable securities. This is one of those line items that I had consolidated in addition to the debts. They had separated it out. buying securities, selling securities, buying securities, selling securities. I like to combine that because I like to see those swings, and you can see what happens. And this is standard in an investing model. They buy, they sell, they buy, they sell, they buy. It looks like they bought about $3 billion. They sold a little bit. They bought a big purchase. I assume they're going to sell a little bit, buy and sell and buy and sell. I'm going to continue those swings. I'm going to repeat the cycle here. Now you might say, well, given what I just said before about not being concerned so much, why couldn't this be zero? I guess it could basically be zero. And again, one way to think about these line items, and this is what I often do concerning cash from investing and cash from financing, is come up with one view, create your valuation, create your analysis, create your goal, change that assumption to something more conservative, more aggressive, and see if it impacts your model. It's probably not here, especially if you're doing valuation. Okay, continuing down. We now have debt, short-term debt, long-term debt, financing leases, capital leases. We also think of as debt. We model that out in the debt schedule. So all these line items are highlighted red because they will come from the debt schedule. Okay. And then we have all these line items I kept in this template. Amazon doesn't have, but they're important to know and consider when you're using this to model your own business. Okay, issuing preferred stock. Although I do believe Amazon has preferred stock, they didn't have any issuances this year. Issuing common stock. Although I know Amazon has common stock, they didn't have any notable issuances this year. Buying back stock. Important to consider that. They had no stock buybacks. Paying dividends. They don't pay dividends. And other. They don't have any of these things. I'm going to copy this to the right. And then finally, they have this foreign currency effect on cash and cash equivalents. This is, you'll always see this line item, or pretty much 99% of the time, in companies that have subsidiaries in other countries. Those subsidiaries' financial reports are produced in their local currency. And when you consolidate, you're going to have currency exchange rate impacts. Positive, negative, positive. I'm going to continue to repeat the cycle here. Positive, negative, positive, negative. Okay. Repeat the cycle. Okay. And I'm going to copy everything to the right. And here's my model. Cash flow for now. Again, this will change a little bit. We're probably going to go back and analyze this and tweak this, even the income statement, after listening to tomorrow's earnings call. But at least now we have the income statement and cash flow statement as best we have done. This leaves us with one final major schedule, the balance sheet. But we have a lot of holes in the cash flow statement. We have several small holes in the income statement. Now's the time to start building the supporting schedules that help the flow and continuity of income statement and cash flow statement, namely the depreciation schedule and operating working capital schedule. So the flow and procedure is build model income statement, build model cash flow statement. Now let's build two of the three supporting schedules: the depreciation schedule, the working capital schedule. You'll then link those into the income statement and cash statement respectively, which means the income statement and cash statement are more complete. Then we will model the balance sheet. We will use the cash flow statement to project the balance sheet. And then finally, we'll build the debt schedule. The debt schedule is going to be the last schedule that we'll build. That's the procedure. So we got a little bit of time. Let's talk a little bit about the depreciation schedule. And first, it's important to understand what depreciation is. Depreciation is accounting for the aging of assets. If you buy an asset, especially one that depreciates heavily, let's say a car depreciates very fast, right? A car, you're driving it, it's wearing out, it's breaking down, the engine's aging, tires are aging, right? When you account for it on your books, let's say we buy a used car for $10,000, or here, let's use this example. Let's say $20,000. It's a truck. Next year, theoretically, that truck is not going to be worth the purchase price. It's been used. 5 years later, not going to be worth the purchase price. It's used. Well, what's it worth? How do you think about that? Well, been a big debate about how the accounting for that goes, but in short, you depreciate it. And there are different ways to depreciate items based on, and their industry standards based on the type of equipment. One of the methods, most common method, is called straight line. Straight line depreciation means the object or property or equipment is depreciated evenly over the life of the asset. Short example is you have a car worth $20,000. Let's say the life of it is 20 years. I know that's a long time, but just for the simple math, let's say the life of it is 20 years. You divide 20,000 by 20, and the depreciation is $1,000 each year. Next year, it's worth 19,000. Year 2, it's worth 18. Year 3, it's worth 17. By year 0, it's worth 0. It's straight line depreciation. That's very common. There's also a note that sometimes at year 0, that object, the property, plant, or equipment, might be worth some sort of residual or scrap value. In other words, you can maybe, after 20 years, trade in that car for parts or truck for parts. Maybe the parts are worth $1,000. And so that $1,000 by year 0 is called the scrap value or residual value. If there is a scrap value or residual value to a property, plant, or equipment, or to your car, you do not depreciate that scrap or residual value. So for example, if I have a car worth $20,000 and I know, let's say by year 0, I can sell it for simple math, let's say $5,000. Then by year 0, I know my car is going to be worth not 0, $5,000. So in order to calculate, use my method straight line depreciation, I don't depreciate all 20,000. I only depreciate my 20,000 minus my 5,000. I depreciate $15,000 of it. So in other words, the formula for straight line depreciation is value of the property minus, do I have it here? I thought I had it laid out here. Value of the property minus the residual value divided by the useful life, the depreciation life. So in this example, 20,000 minus 5 leaves me with 15,000 divided by 10. The depreciation is $1,500 each year. In other words, this year it's 20,000. By year 1, it's going to be worth 20,000 minus 15, 18,500. By year 2, 17. And then by year 0, it's not going to be worth 0. It's going to be worth $1,500. Sorry, $5,000. That's the straight line depreciation method. Okay. Note there are other ways to depreciate assets, and we'll learn this later when we start to do depreciation, which will be on Monday, next Monday. There's methods to accelerate your depreciation. Accelerate depreciation means, or is based on the concept that your asset might not depreciate the same way every year. And a car is a great example. Your asset might depreciate more in the first few years and less later. That's true with cars. It'll age faster in the first 5 years, let's say. So there are several methods of accelerating depreciation. There's this MAKERS, which is the US industry standard called the Modified Accelerated Cost Recovery System. Big word for you are given a set of percentages dependent on the life of the asset. The percentages imply greater depreciation earlier, less depreciation later, and we'll practice this. For example, you'll look up, you can even Google MACRS, and you'll look up if an asset has a 20-year depreciation, what is the 20-year MAKERS schedule? And they will tell you, in the first year, depreciate 20%. Second year, 16%. Third year, 15%. Fourth year, 12%. The percentages are declining. Those percentages you apply to the value of the asset, so you will have a depreciation that slowly reduces. That's the Modified Accelerated Cost Recovery System. Other examples are declining balance or double declining balance. And we'll learn about those. So this example is the example we laid out. This is the truck. This is going back to the truck company example where, of if you recall in the first classes, we're basically a delivery company. We have one truck. The truck is the sole kind of operating asset of the business. We want to depreciate that truck. It costs $20,000. It has a 10-year life. And we're saying that the company's depreciation is $5,000, so it depreciates by $1,500 each year, right? So 20,000 minus 5,000 is 15,000 divided by 10 is 1,500 each year. I'm hesitating, guys. I think did I talk about an asset with a 20-year life? I'm thinking $20,000, 20-year life. I think I changed the depreciation from 20 to 10. I'm sorry. This is the 10-year formula. I think in the second example, I talked about residual value. I said 20. In my mind, I was reading this example that has a 10-year life. I hope I didn't confuse anybody. Whereas, you know, in that example, if it was a $20,000 asset divided by 20 years, yes, it's $1,000 a year, but the residual value, 20,000 minus 5 is 15,000 divided by 20, right? It's going to be 750, right? It's not going to be 1,000. Okay, so sorry about that. So, not, okay. Okay, so we got 5 minutes left. Let's just stop here. We're going to talk about deferred taxes next week. Well, we're going to open up the depreciation schedule and start to lay out and talk about how to depreciate our assets. This is a good stopping point because I believe there are going to be some changes in the way they depreciate and the way they do Capex, which tomorrow's earnings call is going to impact. So next week, we're going to start to build out depreciation. We're going to then link depreciation into the income statement here. If you recall, there's a missing piece here. Depreciation, which will flow into our cash flow statement. Right here. Then we're going to talk about working capital. We're going to build and model out working capital. Working capital is going to flow right into our cash flow statement. And then we're going to have most of our model. Then we're going to build out our balance sheet, the last of the biggest of the major three schedules. We're going to use our cash flow to project out our balance sheet. Then we're going to build our debt schedule. And it's time to value this business, okay? We're going to do a DCF model. Okay. I'm going to email this around. Any questions, please let me know. Please send me an email. And we'll take it from there. Thank you, guys.